be happy to answer any of your questions overall. So today we're going to talk about fourth quarter earnings in this earnings season and give you 6 reasons for some optimism. I want to dive right into it. We have about a half an hour show here, and I want to talk to you about 6 reasons to be optimistic with many of the things that go on with New Year's resolutions. Hopefully everyone is following those New Year's resolutions and sticking to them. I saw a statistic just recently that was I found on Twitter, so I don't necessarily have a source, but it just was interesting talking about how quickly people stop their resolutions within 4 to 5 days. So hopefully your New Year's resolutions include getting organized, investing wisely, putting your money to work, and getting your money to be working for you, not against you, lowering your debt, and many other things we can certainly talk about on this show. But we've really been concentrating on the stock market right now because we are once again just in a phenomenal push here in regards to what is going on in the market. In my opinion, it's probably the least respected, most underappreciated bull market in the history of the universe, but it is what it is, and it is a bull market. So whether you believe we're in the 7th or 8th inning of that bull market is certainly up to you, but if you start looking at what's going on in the market as we talk here on the show, and trying to get people to understand where to invest and why you want to be investing. It's very important to be able to find the right places. We talk about diversified portfolio on this show, making sure that you are diversified and owning a number of different asset classes. And hopefully you're optimistic about the new year. Hopefully you're optimistic about your new changes and your new ideas, your goals that you set for the year, and hopefully one of those goals is to make more money in the overall market. So with that being said, I'd like to talk about five reasons for optimism. Look, we're expecting a really strong fourth quarter earnings season that's coming up here, and it's been going on this month, but just want to be able to talk about the year, really a 14 to 16% year over year increase in S&P earnings is possible with the earnings, the economic surprises, the strong manufacturing activity that's out there, the weak dollar that's been happening, and a few of the really just sort of the primary reasons that really may make 14 to 16% return or year over year increase actually happen. So the positive earnings outlook for 2018 is well supported by any sort of forecast, and also this global growth and also the new tax law. So just want to talk about these 6 reasons for this optimism. With about 50 companies already that have reported in the fourth quarter results so far, the S&P index earnings are tracking at a 12% year over year increase right now. It's a solid 79% of the companies have bested earnings estimates, and 87% have topped revenue targets. And these are raised revenue targets. These are raised earnings estimates. So the obstacles have been raised, the bars have been raised, and certainly they're overachieving, which is great. So both of these are recent and long-term averages overall, and so I really wanted to talk about fourth quarter earnings season, sort of go over this optimism and corporate profits here for 2018. So the S&P 500 has exceeded quarterly earnings expectations for 34 straight quarters, and there's no reason why a fourth quarter of 2017 won't make it 35. Overall, you really have to believe that the increase in that 14 to 16% range may be achievable, really based on the 3 to 4% average upside in estimates historically through earnings growth, maybe driven mainly by technology and energy. Growth is expected to really be broad-based across many, many different sectors, with that sort of reasonable chance that 11 of these sectors will report growth in earnings when all results are in. And this even excludes the sharp rebound in energy sector profits that have really, that were downtrodden last year. And despite tougher comparisons against improving to late 2016 earnings, a double-digit gain in the S&P 500 really appears pretty likely. We're already up 6% for the year, so we've had a great month in January. Typically, so goes January, so goes the year, so pretty positive. Here are the six primary reasons why we expect good earnings season this quarter relative to overall expectations. Number one, economic surprises. The U.S. City Economic Surprise Index, believe it or not, there is such a thing, is a measure of economic data relative to expectations, and this is near record highs. When economic activity surprises to the upside, as it has consistently done in recent months, companies tend to beat earnings. So global economic surprises are also strongly positive, supporting multinational earnings across the board. And this is sort of an unexpected tailwind that really combines with management teams, their tendency to be conservative, not necessarily be too aggressive in their estimates, but also try to tail back a little bit of their expectations so they can surprise the street and make all these analysts that follow their stocks really happy. So this tendency to be conservative, this lack of negative macroeconomic surprises, points all to really good upcoming results. So really solid. Number two on overall six primary reasons why we expect good earnings season this quarter is strong manufacturing activity. Look, manufacturing surveys such as the Institute for Supply Management's ISM Purchasing Managers Index have historically been well correlated to earnings growth, and this means that the strong and generally rising global manufacturing indices are really a positive for upcoming earnings reports. This U.S. ISM Manufacturing Index has been above 58 for 5 straight months, which is basically, it's strong, and it basically shows we're expanding. As with economic surprises, this is not just just a U.S. story. Manufacturing activities picked up steam in Europe. We've been talking about that on the show a bunch. Europe, Japan, and China as well. So energy and technology are really big key earnings and growth drivers, and we're certainly seeing those things. So that was number two, strong manufacturing activity across the board. So number three, in regards to six primary reasons why we expect a good earnings season for this quarter, is the weak U.S. dollar. During the fourth quarter of 2017, the U.S. dollar index fell about 6% year over year, and this is based on average prices. Dollar weakness props up overseas earnings for U.S.-based multinationals, and it really could present sort of a tailwind for fourth quarter earnings, given that roughly 1/3 of the S&P 500's revenue is earned outside the U.S. For instance, years ago, a report was published about Coca-Cola. Here's Coca-Cola as American can be, and 53% of their sales in one of their past earnings calls, 53% of their sales are international. So is it an American company anymore, or is it more reliant upon international sales is the question. So, and you could name a number of different S&P 500 companies that rely an immense amount of responsibility is needed for sales internationally. So the weak U.S. dollar then helps those earnings, and it doesn't look like it's going to turn around anytime soon. It doesn't help you as an individual that's looking to plan for a trip, maybe to Europe for your family, because then the dollar's weaker, and now the euro is certainly higher. At one time, the euro was trading at 108 compared to a dollar. Now it's almost $1. That's like $1.24, $1.25. So huge difference in regards to stretching your dollars if you're going on vacation and going somewhere with a euro. So it's pretty interesting there. So the weak U.S. dollar would be the third reason why we see another good earnings season and are being overly optimistic here overall. We're brimming with enthusiasm and optimism here today on Money Matters with Greg. Real quick, just want to update everybody. You can find us on LinkedIn. You can find us on Twitter. You can find us on Facebook. All of them are Money Matters with Greg, and be able to find us also at Farrell Wealth. That's my firm. I'm CEO and president of Farrell Wealth. It's a wealth management firm that's local here in Valpo, but we serve clients all over the nation. And started this show really as a financial literacy show, trying to help people just sort of understand many of the things that are out there, maybe be able to help you make some money and also save some money across the board. You can also find us on iTunes under Money Matters with Greg. We have a number of different podcasts, and many of these shows will all be thrown up there as well as time goes on, so you can get them, listen to it in your car or wherever you might be with your phone, working out, whatever it is. So we're talking about fourth quarter earnings season here that we're looking at hearing about. Obviously, the fourth quarter is over in 2017, but the earnings are now coming out with a number of S&P 500 companies that have already reported. And we've gone through three of them. The first three were the 6 reasons for this optimism that we're so rosy about here. Overall, are the economic surprises that we're seeing, the stronger manufacturing activity, and the weak U.S. dollar. The fourth primary reason would be pre-announcements. The ratio of negative to positive pre-announcements for the fourth quarter, and just so everyone understands, a pre-announcement would be a company that would really by rule needs to come out and let the analysts know that if something is going to be drastically different in a quarter, whether it be positive or negative, all analysts across the board, those people that cover the stocks individually for their firms want to hear about it. They don't want to be surprised. So they expect to hear from the management team if there is something going on. You can see that just in the last few days with Apple. Apple has slowly let analysts know that their orders for the iPhone 10 have been light, and so they are going to ultimately discontinue the 10. And if they were having robust sales, they wouldn't necessarily be doing that. So they're going to keep it, but they're going to basically retire it. So it's just interesting to see how the news cycle works in regards to their earnings that are coming up here, I think in the next 2 days. So I think they're February 1st is when they have it, their earnings. So I want to keep an eye on that overall. But these pre-announcements are expected, whether it be negative or positive. And this ratio of negative to positive pre-announcements for the fourth quarter was 1.6. Now this is favorable. This is probably the most favorable it has been throughout the entire economic expansion. And though in line with the last quarter, the